Thank you all for coming today. Appreciate it. I'm going to just do a quick intro of our panel, not like a really long one, and then just a quick intro of the topic. And then we're just going to do some discussion and then open up for Q&A. So leave hopefully at least 15 minutes for the Q&A part, probably more. So our panel consists of, at the far left, David Burton, who's a senior fellow in... My far left.
First time that's ever been said.
He's actually always been to the far left of me. So this is perfect. This was planned. No.
You're right.
David is a senior fellow in economic policy at Heritage, where we worked together many years ago. He has worked on many different issues related to financial markets, including securities law, capital markets, and regulatory issues, and even this one to some degree with the deposit insurance issue with me. And then next we have Thomas Kingsley, who is at American Action Forum. He's the Director of Financial Services Policy at AAF, and he's basically worked on all things that touch banking and insurance industries, including a very wide range of regulatory and policy issues in financial services. And then we have Dan Savickas, who is the Vice President of Policy and Government Affairs for the Taxpayers Protection Alliance. And he's a veteran of DC policy, the DC policy world. In a previous life, he was the regulatory policy manager at FreedomWorks. And then last but not least, well, second to last but not least, someone who doesn't really need much of an introduction, it's Grover Norquist, who's president of American Tax Reform, ATR, which is a group that was founded in 1985. 85. I was alive then. He's been a tireless advocate for limiting the size and cost and scope of government, and everybody knows Grover. And then me, Norbert Michel from Cato, and I've been working on financial services issues now off and on for more than 2 decades, but solidly for more than just a little over a decade. Write a lot about this issue. I think FDIC deposit insurance, I kind of view it as the original sin, so to speak. And so I've written a lot of articles and opinion pieces, and I've even got a couple of books if you're interested. I know nobody wants to read a book, but you could skim the book. And there's a couple of them that are relevant to this topic, and they're outside if you want to pick one up on the way. And if anybody wants to follow up on the books or any of this issue at all, my colleague Anne Rulon, Anne is right here in the back. Anne works with me very closely at Cato, and she would be happy to help with any kind of follow-up questions or anything that you have, anything that you would need. So with this issue, this deposit insurance cap issue, it is one that pops up pretty much every time there's any kind of banking industry problem. So if there's a bank failure or a large or a run of bank failures, you hear somebody say, we need to raise the deposit insurance cap. It happens like clockwork. It usually dies. And it happened again in 2023 when the Silicon Valley Bank failure happened. You started hearing about the insurance deposit cap. We need to raise it. And it died. It died quickly because everybody kind of realized very rapidly that it was really only going to be necessary to do that if you wanted to protect a very small number of people at the expense of everyone else. And it didn't really get any legs at all, and it just died. Somehow, and for whatever reason, it has come back. And I don't know exactly what is behind the push from Treasury to do something like this. But my sort of expertish opinion is that that's where it's sort of coming from. And so it's popped back up, and there's a bill in the Senate. It's co-sponsored by Senators Hagerty from Tennessee and also Brooks from Maryland. And the effort has explicit support from Treasury Secretary Bessent, if not the Trump administration, certainly the Treasury Secretary. And what they want to do is raise the FDIC coverage cap from $250,000 per account to $10 million per account. And if that sounds like a lot, that is. That's a huge increase. And they want that on all transaction accounts at banks and credit unions. And they want the FDIC assessment fee to be on only the largest banks, sort of under the idea of, well, you know, they're the ones that need to pay for this, which is bizarre, but we'll get to that. It's very much like the deal that Cam Fine of the ICBA and Barney Frank made to get the Dodd-Frank Act through, where there was an increase in the cap up to 250, a permanent increase up to 250 at that time, and the assessment fee was sort of, the way it was done was changed so that the smaller banks wouldn't have to pay more to get the additional coverage. But this is actually much worse than that. So supporters of the proposal will say, we need to lift the cap to keep the banking system safe, and it's not going to cost anything. That's what they're saying about this proposal. So that's where we'll start, and I'll just throw it out. Does anybody want to jump there? Anybody want to jump in there on we need to raise the cap to keep it safe, and the banking system safe, and it's not really going to cost anybody anything.
I can do it.
Go ahead, David. Go ahead, please.
Is this on? No. Where's the on button? I don't see an on button.
Is it on?
I'll just talk, I guess.
You're loud enough.
Hopefully people can hear me. Haggerty also, Brooks' bill is about protecting Main Street in the same way that the Inflation Reduction Act reduced inflation. It is really the inverse of what it's being sold as. Right now, 99% of deposit accounts are protected. It's $250,000 single and $500,000 for a joint account. Almost all individuals and small businesses are protected. This is really a massive subsidy for banks and large corporations. It obviously won't have an adverse effect on the budget until it does, and it always does. We have financial crises roughly every 20 years, and when that happens, we'll end up potentially having a taxpayer on the hook for hundreds of billions of dollars. And you know, I don't see the logic in imposing large costs on ordinary taxpayers to subsidize large corporations and large banks that behave irresponsibly. And it actually encourages irresponsible behavior because, in effect, if these bills pass, and there's the Maxine Waters legislation as well, what we're doing is setting up a situation where profit, if the risky bets pay off, is privatized, but if the risky bets don't pay off, then it's socialized. So you have an asymmetry, and economists call it moral hazard. And it basically encourages risky behavior. It makes financial crises more likely, not less likely, and these pieces of legislation really do not deserve support.
Can I add?
Sure, sure.
Just one small piece on the risk part. You may hear me over the next hour get a bit indecently excited about the collapse of Silicon Valley Bank. I apologize, we're all friends. But what a fantastic case study. What was it that made Silicon Valley Bank collapse? Was it the deposit insurance limit? No, we know that. It was terrible management, poorly diversified interest rate risk. So for me, it's a fabulous case of this is very much a quote-unquote solution in search of a problem, because we know that the deposit limit had nothing to do with the collapse of Silicon Valley Bank, and expanding the limit won't change that either.
Grover.
The people who advise businesses say if you are doing something, you first ask, if we weren't doing it, should we stop doing it? And if we weren't doing it, would we start? And if you wouldn't start, then don't do it. What we're now asked to do is to expand a government program to have government-run insurance, or structured insurance, to dramatically increase the possibility that they have to do the payout. When you go back and say, would you at the beginning, if you were starting this again, would you say banks might want to have insurance? And somebody says, I know, let's have the post office run it. let's have the government run the insurance. Would you have started this? There is private insurance. Private insurance has been successful, and the other ways of diversifying risk. If we were starting from scratch, we wouldn't be doing this. We'd be talking about diversifying portfolios and having private insurance. Why, in the middle of going too far in the wrong direction, are we having a debate about whether we go further, if there's any debate as to why are we doing this in the first place?
I also want to talk about the cost part of your question, is that the FDIC currently has a reserve ratio requirement of 1.35%, and increasing the limit from $250,000 to $10 million, as the Hagerty-Alsobrooks bill would do, would require a massive special assessment that TPA's estimated would come in around about $42 billion. And as anybody knows, when businesses, banks not excluded from this, when they incur costs like that, they most often get passed down to consumers, whether that's in higher rates, more difficulty accessing credit. This is not going to be a costless measure at all.
Right, and just for the sake of completeness, everybody's on the same page. So let's say the 42 billion is, whether it's exactly correct or it's even in the ballpark, that's fine, right? There's that part of the fund, but what happens in most of the larger crises that we've had is that when there is a crisis, there's not enough in the fund, and by statute, that means taxpayers pick up whatever's not in the fund. So then there will be an assessment on top of that, and it will eventually be paid for, possibly, perhaps. But I feel like we're still kind of all paying for whatever happened in 2008, regardless of what the assessments are. And one more note on the cost: the notion that you're going to be able to put the fee on a big bank or the big banks, and that's that happens in a vacuum. You got to get that out of your head completely. Be blunt. Everybody pays for that, whether it's those banks' customers or potential customers or employees or potential employees that could go to other banks. That the whole system is going to bear that cost, and it has an effect on how those banks act. And it has an effect on how other banks act, and ultimately what happens in the system. So that's one thing that I want to throw out there on the cost. Grover? Yeah.
We make fun of other countries that pick winners and losers, and they tend to subsidize the things that are failing and tax the things that are succeeding. Here we're asking not just to do that, but to pick winners and losers by having the government come in and tax the people who think they don't need the insurance, that can handle it other ways, to subsidize another. So they're picking winners and losers by stealing money from some banks and giving it to other banks. We shouldn't be in the business of the state picking winners and losers, either by subsidizing failure or by taxing one set of competitors and giving the money to another.
Thank you. Another thing we wanted to talk a little bit about is this specific problem that you will hear out of Treasury, or at least have heard out of Hagerty's office, is that the problem that this is necessary to address is that a lot of deposits flowed from the smaller banks to the larger, supposedly too big to fail banks. That's one of the ways that they justify this idea. And the idea that what they're getting at is that the largest banks, the too big, like the G-SIBs, they have an implicit too big to fail subsidy, and everybody else is paying for that. And one way that you see that is when the Silicon Valley Bank sort of thing happens, a lot of money flows from the smaller banks up to those banks as if that will protect their money. So we need to correct that, and the way they want to correct it is to raise the cap and raise the fees on those larger banks. Of course, that's all an implicit thing. I know what I want to say about that, but does anybody on the panel want to jump in on any of that?
It's a fun argument, but we've seen the New York Fed demonstrated that after the Silicon Valley Bank crash, that most of the deposit flight happened to money market mutual funds and elsewhere. I feel like I've been talking about shadow banking since 2008, and we can have that conversation at a different time after a drink. But the point is, these funds definitely didn't go to the mega banks, and we've seen that.
There's also a lot of shadow banking stuff in one of those books that I mentioned out there, but that's, well, there's a great New York Fed paper, and we can send it to you later. We can talk to Ann, I can send it. It shows that what happened was there was a large set of deposit outflows, about $500 billion, long before the Silicon Valley Bank failure. And that was probably a COVID hangover. So there was a buildup in deposits, maybe extreme buildup, and then that kind of started to come out of the system. And then after the SVB failure, you had another roughly $400 billion leave. And that flow was from super regional banks, what are called super regional banks, which are really just a made-up term. It's really just larger banks, up to the largest banks. And that is this justification. That's the piece of this justification for we need to stop those deposits from flowing out of the banks, right? That's the idea. Okay, but there's a couple of problems here. They want to do this, to stop that, they want to do it with more federal backing. Well, all of those flows occurred after the systemic risk exception was announced. So right away, that's a problem, because you have the government announcing that we're going to cover uninsured deposits, and then the money left those banks. Well, if that's the case, then that sort of is at odds with the idea that you're moving it for extra protection, right? So that's one problem with that. And then the second problem is that the Fed paper also shows that shortly after the money flowed into those larger banks, it flowed out of the banking system altogether. So that completely destroys the notion that that money flowed into the GSIBs for the extra protection. It completely left the banking system. So that makes absolutely no sense whatsoever to say that we need to raise the cap to prevent that sort of deposit flow. And then I might be on an island on this one, but this is simply saying we can't let money leave the banking system. That is absolutely, positively, hands down, a horrible way to structure the regulatory system. You cannot do that. That is an absolutely awful idea. We should not do that. That is the opposite of creating diverse and strong financial markets. You're literally saying that everything has to stay in those banks and be run exactly like this. That is how you get more fragile markets. That is how you get more financial crises and more government bailouts.
It worked for the East Germans for 80 years.
And it always works for a little while, right? Until it doesn't, and then it's a spectacular failure. So, anybody want to talk, on the panel, anybody want to talk a little bit about the concentration? So this thing is named the Main Street Investor Protection Act. Who is this really protecting? What do we know about who's covered, who's not covered, how many accounts are covered under the 250, that sort of thing? Anybody want to do any of that?
Yeah, I think any one of us would say, oh, there we go. Any one of us would say the vast majority of existing deposits are already covered under the $250,000 limit. Some studies say more than 98% of accounts are covered. Some say 99%, same but different. But this is mostly targeting the mega corporate accounts, the biggest depositors, which make up a larger share of deposits money-wise, but in terms of whose accounts are being covered, the vast majority, over 98% of people, are already covered under the existing limit. And to note, amongst G20 countries, the United States has the highest raw dollar value deposit insurance limit, and as a percentage of GDP, we're fourth behind, I think, Mexico, Brazil, and Indonesia, countries that have vastly smaller economies than our own. So we're already leading the globe in deposit insurance. So a move from 250,000 all the way up to 10 million would only help the biggest depositors, not the average Americans. It's not a Main Street bill.
Yeah, no. Even at the 90th percentile, the median account balance is less than $100,000, and at the average, which is very skewed, it's under the 250. So it's incredibly concentrated. And then what is very often ignored is that even with the 250 cap, you can get coverage above the 250 cap by spreading accounts around, by using reciprocal deposits and sweep accounts. So that's one of the things that I find interesting, and maybe somebody wants to talk a little bit about that, what I'm about to say here. Normally, when you hear this talk about raising the cap, in the past, a lot of the community bankers vocally support it, and none of them say, we don't need to do this. But you don't see that this time. This time, you see a lot of community bankers coming out saying, this is not a good idea. This is not what we need. This is not how you strengthen the system. We're going to pay for this. Don't do this. And I think that's probably partly because we're talking about going so far. Does anybody want to?
The smallest banks, the community banks, I don't know, 3,500 or so,
Yep.
they talk to congressmen more often than the bigger banks do. But when they had testimony before the House Finance Committee, the person who spoke the most was the woman who represented a small community bank who didn't want any part of it. So there's a lot of opposition from there. Now, they bought off the trade associations by saying, well, we won't make you pay for any of this for 10 years. So in 10 years, we'll all show up, they'll all get whacked, they'll come and bother you, and then you should laugh at them. But the only reason you're not getting the smaller banks going, this is a bad idea, please don't do this, is that, well, it's something and it's free for the moment, but in 10 years it won't be free, and you will not have made permanent friends.
You guys good?
Well, I guess there's one other thing I thought I might mention, is the banking system's not quite as healthy as everyone would have us believe. There's roughly $2 trillion in unrealized losses that banks don't reflect on their balance sheets, but are there, and the FDIC keeps numbers. So if we have another economic reversal and there's financial stress, you could see a fair amount of bank failures, and instead of encouraging them to behave responsibly and try to clean up their act, this legislation would encourage risky behavior and accelerate the problem rather than solve it.
Just briefly, if I may, I might be alone in thinking that bank collapses are signs of a healthy economy. And we should be not celebrating, but we should at least not be. What is the purpose of the FDIC insurance? Is it to prevent any bank, no matter how poorly run, how poorly diversified, from ever collapsing at any point in the future? That's a very different goal, and it's one that puts these artificial constraints on the economy.
Aaron Klein at Brookings is fond of saying a banking system with no bank failures is not a healthy banking system, and I think that's dead accurate, right? There's no way any set of businesses in any industry is going to have zero failures. The numbers aren't on your side.
We know that. I mean, restaurants are pretty good because so many of them fail.
Yeah,
and
you end up with better ones.
If you just sat there and said we're going to force people into the restaurants that exist today, you wouldn't have new ones coming in that were good, and you'd have fewer failures under that theory. But no, the public schools are an example of not letting people go bankrupt.
That's a good one.
And sorry, just quickly, this is why, for me, Silicon Valley Bank and the Biden administration's response was so fascinating, because they went in over the weekend and they said, fine, we're going to use the systemic risk exception. Everyone is covered for everything. And to me, this is absolutely the antithesis of the purpose of deposit insurance, which was, let's remind ourselves, to protect the smallest depositors, no, from self-enforcing runs at fundamentally sound banks, no, using funds collected from those banks themselves, also no. So in that one fell swoop, and I do sort of understand it, because someone went into the White House, into the West Wing over the weekend and said to Biden, presumably in the morning, the financial system is about to collapse. What do we do about it? And the answer was everything. We do absolutely everything, with no thought as to what the ramifications of that might be. But in so doing, they've created a truly alarming precedent.
And let's not forget, we talk about FDIC insurance, that's one piece of the system, right? We have a Federal Reserve, which is the emergency liquidity provider for the banking system. We also have the Federal Home Loan Bank system, which banks use for advances in emergency liquidity situations. And there's also New York Fed paper that shows that actually worked. And I might have issues with whether that could work better, but that actually worked. So what this proposal is saying is that on top of the Federal Reserve providing emergency liquidity, on top of the Federal Home Loan Banks providing emergency liquidity, all of which is backstopped by the taxpayer, we need to now go from 250 to 10 million to basically back everything. There's really, there's no limiting principle there at all. And at the very least, you've got an incentive problem in that when you do that, right? You've got, if you're a large depositor, you have even less reason to worry about what the managers of a Silicon Valley bank are doing with your money. You don't care, right? That's probably not the best approach. I don't know.
When we're dealing with somebody who's putting $10 million plus of their payroll into a bank, we're not talking about unsophisticated people.
Right, yeah, right.
First of all, they made $10 million, which they're a little bit ahead of me. And they've held on to it, which is even more so. But these are businesses that could go into 3 different banks with ease and do it and diversify portfolio that way. Or if they really are concerned, buy private insurance. I mean, there are a number of ways to deal with this other than going to Washington to ask them to manage it.
Yeah, and you're not going to have somebody who, if it is in fact a payroll company, right? That money goes into that account, payroll is made, that money comes out, like that's gone, right? And then a new batch is gonna come in on the next payroll run. It doesn't just sit there the whole time. So that even if that was 100% in trouble, that doesn't say anything about your ability to make payroll going forward or to generate profit going forward. I think this is much overhyped in terms of how risky and dangerous that is, and it also says absolutely nothing, again, about emergency liquidity provision or your provisioning inability to do something else to protect yourself. All of that matters here, and none of that is being talked about, and it's just sort of being, this raise the cap thing is just being thrown at that. Anybody else want to? Okay. The other piece, I think, I'll see if anybody wants to jump in on this. I think it is underappreciated how much of a crowding out effect we have. Grover mentioned a little bit about this at the beginning in terms of private insurance solutions. Few people know about the credit union history on private deposit insurance. But the bigger picture here is that I think, and then you guys can chime in, but I think I have always made the argument that as long as you have the FDIC system that we do have, you are not going to have any kind of a rich, diverse, strong private deposit insurance market or anything that looks anything like that. Because it doesn't have to be exactly like we have it. It just has to insure people against loss. And that's what financial markets do. But as long as you have what is effectively a subsidized rate government insurance provider, that's very difficult for a private company to compete with. So by raising the cap from 250 to 10, you're going to basically destroy anything that was left. And I don't know that there was that much of an incentive for any kind of private company to start this to begin with. I think there's a lot of crowding out there, and I think we should be talking about going in the other direction with the cap, not the direction that we're talking about.
Well, I think the right solution is to mandate that the banks acquire private deposit insurance and then have the FDIC as a backup in the event that the well-capitalized private insurers fail. And that would have a number of salutary effects. One is that the taxpayers are much less likely to be on the hook. Secondly, the private deposit insurance would in effect become auditors or supervisors of the banks in a much more realistic fashion than the politically motivated government regulators, and you're likely to get better outcomes.
Does anybody else?
For
Go ahead.
me, it's a comparison to two other areas in which the US government has intervened heavily to the detriment of the private markets. We've seen this with the government-sponsored enterprises and the secondary mortgage market, and we've seen this with the National Flood Insurance Program and what small few private flood insurers we have. So these are all examples of cases where an intervention has been deemed necessary and it has been done in the worst possible way that leads to a distortion of risk, distortion of incentives, and fundamentally, we're all on the hook for it.
Yeah, I think there's also.
One other quick thing on that. Americans tend not to realize, in many foreign countries, you either have mutual insurance or private insurance rather than government insurance. We're atypical, or at least
Somewhat.
50-50, in the sense that we only have a government-run system, except for some credit unions.
Yeah, I think this goes to something you were talking about in the lead into this thread, is that there's a fundamental difference between government insurance and private insurance. If you think about car insurance, if Geico was offering way too lucrative benefits and coverage, their bottom line would be hit pretty instantly, and they'd realize that and they'd have to adjust. FDIC can just mandate a special assessment, and if they can't cover it, they can hit up the taxpayers who can't say no, or you end up in jail.
Yeah.
Like, the government is immune from forces that private actors would have to deal with to know what level of coverage is wise, and the government does not have to discern that.
That's right.
And especially going from 250,000 to 10 million, private insurers could not possibly hope to compete with that number, especially when the government can do it by fiat.
Yeah.
Well, and also inevitably, private insurers would have differential rates. They'd insure a bank that was more risky at a higher rate, which would, of course, encourage the bank to engage in less risky behavior.
And to publicize what they're doing, more of what they're doing, I think. Be more disclosure in that scenario, I believe. We're about a little bit about 35, almost 40 after. I think we can keep going. We can just open up for some Q&A. I think it would be fine. I was going to go till about quarter till, but I think that's close. If anybody has any questions for anybody up here.
We've answered all the questions.
It's my understanding that the FDIC insurance programs are very popular. Does someone want to comment on,
Yeah.
On that?
Yeah.
Or,
Yeah, sure.
On the perspective of an ordinary American who thinks that they can only put their money in things insofar that they have FDIC insurance?
Sure. I mean, historically, it has been popular. It has been incredibly popular with community banks. That is primarily the reason that it was created in the first place, to help the smaller banks, to shore them up. Obviously, it would be popular to tell every American, hey, you don't have to worry about losing any of your money. So yeah, I mean, it's certainly popular in that sense. The actual cost of that, though, which is usually glossed over, is a lot of the turmoil that you get in the banking sector. Believe it or not, the United States has one of the worst track records in terms of financial stability of any developed country. And it's partly because of that. And in spite of the sort of like rosy picture that government officials paint and about FDIC insurance, and about how wonderful it is and how it quelled the panic in the Great Depression, which it certainly had a part of doing. You don't need that system to have that effect. In other words, if you have the Great Depression and you want to tell every American, don't worry, government's going to make you whole, you could still do that without an FDIC deposit insurance system.
Well, just one thing. I mean, we've mentioned it, but this bill, or these two bills, are not about protecting ordinary Americans and small businesses. They are covered now, period, full stop. 99% of deposit accounts,
Yeah.
according to the FDIC, maybe some other people put it in 98, are covered, right? So this is about protecting large corporations and banks that engage in risky behavior or don't do due diligence, period, full stop. This is not about protecting ordinary Americans. We shouldn't let the other side engage in that falsehood because it's simply contrary to fact.
Yeah, and while we're talking about alternatives, like all that, that's fine. Look, that's not actually on the table. But the bill itself that's on the table and that proposal, if that dies, it does absolutely nothing to the system. Like, it's fine. The system is would be just as popular with everybody as it already is.
I think it goes back a little bit to the last question we were just talking about, private versus public sector. It'd be, of course, nobody here, I don't think, is saying that FDIC is not offering a service that there would be demand for in the private market. But to say that FDIC is very popular would be akin to me saying, like, look at how many people mail letters through the U.S. Postal Service. Look at how popular they are. Well, of course, when you ban or crowd out any competition and you become the de facto option, of course you're going to be popular. And I think you'd see that same level of popularity in just a more market-sensitive, cost-effective way if we allow more private options to come on board.
Sorry, just one thing on that. Norbert mentioned that this idea that when Silicon Valley Bank failed, the Biden administration didn't allow the FDIC deposit insurance to even work. So going into this, which should have been one of the most perfect test cases for the system, the decision was made at the top to waive the entire process entirely. So when Norbert says there are other ways of guaranteeing trust in the market, we've seen that we're not even using the ones we currently have.
Yeah, don't get me started on Title II of Dodd-Frank. Anybody else? Any other questions? Anybody? So few questions. Yes, sir.
Talk a little more about the private insurance alternatives to spend FDIC.
More about the private
Private
alternatives?
insurance alternatives.
Oh.
What legislation would be necessary and how that market has grown recently.
I think legislation would be necessary because I don't think that you get that to any real degree without paring back the existing system, without shrinking what the FDIC does and what it provides. I could be wrong. I mean, that's my view of the way this has unfolded since the 1930s. Prior to the 1930s, you had state governments doing it, and that was a disaster. They didn't have any money anyway. And then even if you look at what happened during the Depression, Roosevelt, well, he says he didn't want to do it, and he recognized how bad of an idea it really was, but kind of felt backed into a corner. I think that's maybe a little bit BS, but that's what they say. But they even then recognized what that would do in terms of crowding out, private markets. And, the financial markets that we have now, although they were sophisticated then, probably much more than people realize, they are much more sophisticated now. And, taking on risk and diversifying risk, that is what financial markets do if you let them. You have to let them. And if you have them competing with the federal government, you make that much, much harder to do. And I just don't think that you're going to get to a private system. What it has basically been taken away from the credit unions. Credit unions had a carve out at first, and that's basically just been sort of like knocked away year after year after year. So like that's not even a thing anymore. And I think that's why I think you would have to have legislation that at the very least shrunk the limit, the cap. I think better is shrink the cap back to pre-Dodd-Frank era numbers and get rid of the systemic risk exception. I think you need to do at least those two things, at least.
Well, to actually make it work and make it be real insurance instead of pretend insurance, like you talked about state insurance. There was this thing called MISLIC in Maryland, the Maryland Savings and Loan Insurance Corporation. It basically had no money, but all the SNLs said insured by Misley, and there was no money, so when they all went down. All right, so what you need to do is you require the banks buy private insurance, but then you make sure the insurance is real insurance by requiring it be from well-capitalized insurance companies that can actually meet the obligations, and then and then require diversification of risk on those so that the capital of the insurance company exceeds the potential loss from any given depository institution by a factor of, say, 10. And if they exceed that, then require that they, in turn, get reinsurance from other insurance companies. In other words, form a syndicate and spread the risk among other well-capitalized insurance companies. If you set up the system like that, the FDIC would almost, although it would be a backup, would almost never be on the hook. And you would have all the salutary effects of taxpayers not being on the hook. You would have private insurance companies assessing differential rates based on risk, which would discourage risky behavior. And that would lead to fewer failures, better protection, and less demands on taxpayers. And like I said, roughly every 20 years, the taxpayers are on the hook for massive amounts of money, and nobody seems to care.
There's a pretty good corollary to that kind of system as well in the mortgage insurance market. So you have private mortgage insurance that picks up after the first 20% down, anything that doesn't have 20% down picks up the remainder. And they have the PMIERs standard that the FHFA has promulgated that they have to follow. So there is a lot there that could be put in place.
Well, and there are things we can learn from other countries. Other
Yes,
countries do
yes.
things similar to this. This is not like some radical, whacked out, crazy idea. It's done right now in a lot of foreign countries and for the a subset of the credit union.
And it's actually, I think, a shame that, I mean, this is just me ad-libbing, but it's a shame that the administration, or let's say the Treasury Secretary, is pushing this proposal instead of things like that proposal. That's incredibly unfortunate, I think.
One of many, unfortunately.
Says the governor. Yes.
Can you talk a little bit more about the 10-year grace period? I believe is just to assess this,
Why that's a massive support for this.
Yeah, anybody? Anybody want to touch that?
Well, I don't know the number, the exact amount of what the cutoff is, but it basically, they believe they were covering all of the community banks.
Yeah, basically, it's just like a GSIB size cutoff. So it says, it's kind of paraphrasing, but like basically for 10 years, none of the community banks are going to have to pay for it. And that's basically almost 4,000 banks that we're going to say, you're not going to get assessed for this. The problem, one of the problems, of course, is that if there is a problem, that goes out the window. Everybody's going to pay for it. So it's really just a fiction. It's just sort of papering over who would actually pay for it if there's a problem. So it's a nominal fee up front, but that's all it is.
The drive for this seems to be pushed by trade associations for mid-sized banks.
Yeah, yeah.
As opposed to some consumer need. But if you run one of those trade associations, you need to write letters back to the people who fund you on a regular basis and say, why are you sending me money? Well, I'm going to get you this thing for free, and it'll be great. You can't talk them out of it because you're not actually talking to the mid-sized banks, other than they've been told they're going to get a free thing.
Yeah, I mean, that really does seem to be what's going on right now, but
And forgive me if it's a little reductivist, but as we've said before, it really doesn't matter which size banks are paying on which time frame, because we all are, in the form of increased premiums down the line. So how that shakes out sort of is irrelevant.
And I agree with that, and I agree with Grover. I would add, though, that it's another negative consequence, especially for people here in DC, but I think probably broader than that. You've already got this ridiculous small bank versus big bank thing going on. So now we're gonna have small banks, medium banks, whatever the hell that means, big banks, all against each other. It's just like, this is just absolutely ludicrous. And if there's any irony in the situation, it's that whoever it is in this mid-size regional bank area is saying, well, the problem is those too big to fail banks. So now what are you gonna do? You're going to increase the coverage limit for their customers, and basically all you're doing is turning them into what they're bitching about. So you've just created more too big to fail banks, or just not quite as big as those other ones.
And it's even
If
worse
that's
than-
true, but
It's
I don't
even
know.
worse than that, because it's
Yeah.
saying to the banks, compete on the worst possible business
Right,
models.
right.
Like, don't bother
Right.
diversifying. Find all the biggest institutional investors you can,
Right.
because those are the models we are rewarding.
Yeah. That's a lot more than what you asked, but
I was just wondering, could you address the idea of linking the FDIC limit to inflation and sort of the regulatory consequences of possibly doing that? Because it seems as though Silicon Valley Bank was the main catalyst for the renewal of this discussion, but also with inflation, just could you talk a bit about that?
Well, if we'd done that from the beginning, we'd be about half as high as we are now. So that would be progress. We've way outdone the inflation coverage by factor two.
By
more.
far.
Yeah, and just hearkening back to a statistic I cited earlier, the U.S. is by far the highest amongst G20 countries in terms of deposit insurance, fourth highest in terms of GDP. We don't need to go higher than we're at now, inflation or otherwise.
Yeah, I'd be all for adjusting it back to where it would have been. It'd be fine. And there's even, like, if you wanted to go down that road, like, there's even an argument to be made, I think, of, okay, maybe we need to do something to cover the smallest depositors, or the least sophisticated depositors. Well, we haven't done that since the 1930s. That's just not what this is about. Anybody else? We're good, do you think? We're good? We're good? Anybody wanna, we can wrap up?
Yeah. What we ought to do is support what Trump tried to do in 2019 and what Bassett wants to do now. And our friend Ted Cruz has legislation in the Senate, but it can be done, according to Bassett, by a regulatory rule, rulemaking, which is to end the tax on inflation for all capital gains. So the cost basis for a business, your stocks, your home, your farm, would move up with inflation, and so you'd only be taxed on the real gain when you sell your house, your farm, your ranch, your small business, the stocks that you own. This would tremendously increase the wealth of the American people. 60% of people have stocks, 60% of people have houses and so on, and it's a much better project than this bill.
Thank you, Grover. Thank you, Dan. Thank you, Tom. Thank you, David. Thank you all for coming. And I'll allow it.
The deposit insurance fund level, what is the current reserve ratio?
Oh, geez.
1.35%.
Yes.
So the current reserve ratio for deposit insurance fund is 124%, well in excess of the statutory minimum. And so I would just encourage the organizations represented here today, Cato and others, to have a fact-based conversation with policymakers using actual data points that regulators and folks on the Hill are making these decisions with. So we appreciate the opportunity to ensure that lawmakers who are supportive of this legislation, their voices are many in both chambers, could be parts of these conversations moving forward as well. So if anyone would like
Did we use data that was not factual?
Yes, in the fact sheet that was handed out today, it's by data that is not supported.
Which fact sheet?
The handout left on both chairs. So just appreciate the opportunity to use data that is correct to ensure that.
Always.
Yes. And so we just encourage that. And I would also pose the group, why do you think this is such a significant priority of the Treasury Secretary and the Trump administration at this point in time?
I think you'd have to ask them.
Okay. Well, for those who are interested in delving into the reasons why the administration is so supportive of this effort, I encourage you to read the op-ed published by the Treasury Secretary on this topic, outlining why an expansion of government is so important for viable community banks and mid-sized banks in this country. So, thank you.
Was that a question?
Yeah, I think he also spoke to the issue of moral hazard as a danger and what has flowed from people's sense that the government's going to bail everybody out. So I thought that part of his essay overwhelmed the other parts, which are odd to understand. But I did hear one question from the audience wondering what this wonderful chart was. And this is the chart of party control. The top is the Senate, the bottom is the House, and that little unimportant skinny one in the middle is presidents, because they start wars and have scandals, but they cannot raise taxes or spending. So from 1932 until the yellow line, 1994, that's 62 years. The Republican Party controlled Congress twice. Okay, the PRI in Mexico did not have that kind of a stranglehold on power. So we had a one-party state for 62 years. Democrats could pass anything they wanted. Now, they'd have to wait till Nixon left and stop vetoing this, or wait till Eisenhower leaves. But over time, they could pass anything they wanted until 1994, which happens to be the year that 96% of Republican House and Senate members signed the pledge never to raise taxes, and have kept it since then. After that 94 period, the Republican Party that will not raise your taxes but might invade small countries they can't pronounce, hence the little blue line in the middle of that, 18 years of Republican control and 6 years of Democrat control. The difference being when the Republican Party ceased raising taxes. And if you don't spend money on FDIC fund projects and raise taxes there, you get to keep power.
Thank you, Grover. Thank you all for coming. I appreciate it very much. And again, my colleague Ann Rulon is in the back if anybody wants to follow up. Thank you.